Alright, just give me one moment. Go do something. Alright, it's Monday. It's Monday. So as mentioned in the weekly outlook, we are seeing this become a swing point in real time. If this candle closes above that wick, it's a swing point. I was just hesitant in the weekly outlook that we may get a gap lower, but we ended up getting a gap higher as denoted by this new week opening gap. But as long as the gap wasn't, massively 200, 300 handles lower, I was going to remain bullish. We wick away from this discount wicks upper quadrant. If I put a fib on, it's a lot easier to see. Meaning we trade down towards that wick and then it rejects the upper quadrant. And that's indicative of strength. Then the body gets pulled all the way back up towards the mean threshold of the bullish order block. It stays above that mean threshold, as you can see there. And now we gapped higher at the open last night, and we traded higher overnight, so still bullish. And I'm looking for this bearish order block to be traded through. 4-hour chart is more of the same, but obviously we have a lot easier to see relative equal highs there. So if you take the daily bearish order block, that one, go onto your 4-hour, reject it through, that's what we want to see become an inversion. And you can very clearly see that's aligned with the new week opening gap level because that's the high of the order block where the candle obviously closed, making it the new week opening gap high. So I want to see that traded through. This 4-hour SIBI, I want to see that traded through, and then if you want to refine it more, you can refine it down to this SIBI and look for that to be traded through, but I'm cutting through candles from the original, well, technically it's a suspension block, but I'm going to classify it as a SIBI. Hourly chart, we're clearly due for some kind of retracement because we've just had a lot of expansion, and then beyond London, the London lunch hour from 5 o'clock to 7 o'clock didn't really do anything, and then the pre-market range also didn't really do anything, so I guess we're going to have to sit on our hands until the market open, see what that volatility does. I would like for it to send us lower into the Asian inefficiency here. This Fair Valley gap is from a 5-minute chart actually. This Fair Valley gap, I'm basically combining them because they're directly next to each other and they will correspond as pretty much the same level. So rather than going for the deeper one or going for the higher one, I'm going to use both. I'm going to treat it like one Fair Valley gap. I would like to see price and market open trade down below these relatively equal lows. Either from here, use London's breaker and Fair Valley gap to trade higher, or trade below London low, below these lows, and go into Asia's Fair Valley gap and use this as its support point to rally higher into our objectives. Now, I'm not demanding that we completely invert this 4-hour SIBI this session. I'm not demanding that at all, but the high of this becoming the inversion point is going to be the draw. So the high of this gap at 671, that's my overall draw for today, tomorrow, and Wednesday. The reason it's 3 days long is because we have a bank holiday tomorrow, so I don't really use the data from a bank holiday that much. can go for trade. Morning. Okay, in terms of pre-market liquidity levels, we've got these relatively equal lows. That's our pre-market low, and then we've got this pre-market high. So that's what we'll be looking at. These are relatively equal because the wick, although they have traded above, it doesn't mean they're not relatively equal. They're still relatively equal. Retail still sees this as a respected support, but usually when you sweep it, you're going to have a more prolonged run because it needs to generate more liquidity at that level because it's just swept this high with a couple ticks. So if it wants to come back into it, it has to generate more liquidity, and it's going to do that by running lower or consolidating, and then usually both before the reversal. So it takes the high, spools, IO fed, keeps spooling, deeper retracement. This is all in order to build up liquidity at these relatively highs. Runs lower again into this inefficiency, falls short of this low, and then we've got our rally higher. But if you zoom out a bit, this is a consolidation. So really you want to look beyond the pre-market low and high today, probably at this level, at any of these London support levels, and then in terms of buy side, I'm not really using a fixed buy side draw, I'm using the inefficiency here, this high. So I'm not using like any highs in this segment of price action. I will refer to London high because you should always refer to London high. But beyond that, it's the fair value gap high. Hello, Sui. Hello. 17 people like the stream if you like the stream. Let's look at the regular trading hours chart. We have premium opening gap. So from 25,198 to, okay, it's like 350 handles. Happy Monday. Yeah, happy Monday, Zach. Amazing trader and analyst. Thank you. Yeah, in terms of the regular trading hours gap, or the opening range gap, it's going to be multiple hundred handles, so I'm not going to rely on seeing it give us a full gap closure. In fact, that would be very unlikely. Would want to see it use more of the wick levels to trade higher. Not the wick levels, the upper quadrant or the consequent encroachment level to trade higher. Or just completely ignore it and run up. That would be nice. In any case, I'm bullish, but the scenarios I'm framing are we can take out this pre-market low, trade higher, take out these lows, use one of these fair value gaps to trade higher. We can take out London low, use this fair value gap to trade higher. Or what I'm hopeful for is, well, not hopeful for it, but we could also just completely shoot up. So those are the 3 bullish scenarios, or 4 bullish scenarios I have in mind. I think I started the stream a little bit too early. I should have waited a little bit more. Until then, let's look at London. So London is the first about hour of London does nothing but consolidate. This is a good thing, although you have to sit through an hour of consolidation. As long as you're not getting caught up in trying to catch something inside this chop, it becomes very easy to trade the rest of London. Because if the first hour's consolidated, then that sets the leg for the next 2 hours to be, manipulation and distribution. Classic AMD here accumulates. Next hour of London manipulates this low at 330 or near 330. That's the London sweet spot. So give or take half an hour from 3:30, meaning anywhere from 3 to 4. you'll usually see the reversal happen around that point and then it distributes higher, which it does. Leaves a balanced price range, takes out the short-term lows, rallies higher, leaves all these breakaway gaps indicative of strength, and trades higher, and you can use a fulcrum on the Judas swing. So the Judas swing would be this low, and this is technically a dealing range. So I know some people have been asking about dealing ranges. And because it's leaving breakaway gaps, you'd want to use one of the further away standard deviations. So rather than targeting 1.5, you target something like 2 or 2.5. And then very easy targets. Crazy, my time zone has moved forward by an hour. At 9:30 it used to be 4:30. In my area now open is 3:30. Oh, nice. In England we have time zone shift as well, but it's 1 week earlier. And then the market opens at 1:30 p.m. for that 1 week. But once America's daylight saving shift happens, then it goes back to 2:30. But my favorite week of the year is when for that 1 week we have market open at 1:30. I don't know why. It's just nice. Okay, lots of engineered sell side here. I'd expect that to be run into. But I've got 2 minutes until the open. Today, I'm looking for long setups only because I have a very bullish bias. Very bullish bias. In terms of the dollar, still bullish on the dollar. I shouldn't even be showing this, but we have this very small, negligible gap, but it is there, and it's aligned with these highs. So if you're using classic support and resistance, this is a case where classic support and resistance would probably work. Because it's acting as a mitigation block, we're already bullish. We have discount sensitivity from this impulse price swing. It's rejected this level inside the fair value gap, which is just below 50% of the impulse price swing. So, and that's using the bodies, not the wicks. If you use the wicks, it gives you the same thing, but more accuracy comes from using bodies, especially on Forex. So I want to see this trade higher eventually, but I'm not sure if that's going to happen very strongly today because we're on the verge of bank holiday tomorrow. So I'm not putting my bullish bias on the dollar in the way of my Nasdaq trading. Because normally if I'm bullish on the dollar and I'm bullish on the Nasdaq, I'll wait for something very, very obvious with a little bit less risk on the Nasdaq. But because bank holidays tomorrow, I'm not expecting huge movement from the dollar today or tomorrow, so I'm fine to trade the Nasdaq with any bias as long as it, regardless of what the dollar's doing, I'm fine to implement my bias on the Nasdaq. Do you think it's a classic sell day if London holds its high? I mean, if it does, then yeah, it's obviously a classic sell day. But I want to be bullish, and I think we're going to have to drop beyond the pre-market low, maybe beyond the London low into this high, this fair value gap, and then start trading back into the highs. Did you mention something about bank holiday earlier? Yeah, so Tuesday is bank holiday for the US. So I'm not going to be trading tomorrow because Tuesday's bank holiday. As you told, we are at the same level as daily order block and an end log. Yeah. 27th of October's new week opening gap, plus the new day opening gap from the 5th of November. This high to this, or this closing price to this opening price, which is the bearish order block. Could initiate dealing range on a London sweep. Could initiate the dealing range on London sweep. Oh yeah, yeah. Yeah, that'd be fine as well. How about London session tomorrow, or is it less probability? Um, Technically, it's okay, but the thing is, I just don't like trading bank holidays because if the banks aren't trading, then I'm not going to want to trade. It interferes with the daily range, that's why I don't trade London either. But if you're trading very, very, very short-term setups in London, then it's fine. But my idea when I'm trading London, it's all about the engineering of the daily range. I'm always incorporating the idea of where is London relative to where the day should go, and then that's how I'll trade London. So if I'm looking for a London silver bullet, I won't trade it if the daily range isn't going to form in the way it should normally form. On a bank holiday, the daily range just isn't going to be engineered the same way because half the daily range is cut off. So uh, I refrain from London even on bank holiday days because even though it's not a bank holiday for the UK, it doesn't really affect London. What affects London is the daily range engineering that's going to happen in New York. And if New York's got a bank holiday, then that's not going to take place. If that makes sense. Okay, waiting for a first presentation of the value gap. Let's put the opening range gap on. Alright, so as we mentioned earlier, because it's a very, very large opening range gap, you don't want to see it fully close in if you're bullish, obviously, because that's 500 handles or however many handles this is. 342 handles against your bias. You're telling me it's going to go back in your favor if it drops that much? Obviously not. So in a case like this, because the opening range gap is 340 handles, you don't want to see it trade into the lower quadrant. You don't want to see it trade into consequent encroachment. It can and technically still be bullish, but just because of the sheer amount of handle size away it is, I wouldn't want that either. The max I would want is the lower quadrant, and maybe a little bit beyond into the Asian fair value gap, and then avoid touching the consequent encroachment. What we've actually got today is it's just wicked into it a very small amount. That's 10 handles, and it's left, so and that's fine. Stop old par. There's like a 6-month difference between us, so shh. Okay, we may miss the train here. Oh, we have missed the train here. Okay, that's bullish order block. In the next 3 seconds, it will be a bullish order block at least. And then you want to see if we can get a first presentation fair value gap. You could take continuation buys on the bullish order block if it rejects it and starts showing strength, but I wouldn't, just because we're not in a favorable pricing. Going to measure from this impulse price swing to the fair value gap's high, which is my draw. And I'm going to do this. That's going to give us discount premium. PA is such a World War One term. Or par, yeah. I'm looking for a retrace to the 930 fair value gap and looking for longs from there. I would not do that because I want, if you're bullish, you want to see this left open. You want to see that left as a breakaway gap because that's the 930. It's rallied higher. Look, I'll explain. It wicked into the opening range gap, a very small amount, and it rejected and displaced higher. Then it left this as a breakaway gap, didn't return into it, created a bull order block. That's an institutional level where banks are going to be in. And now, if it retraces into that, that would be an okay-ish entry. But, waiting for it to trade into that would be where I don't want here. I would have my stop loss a little bit there in the breakaway gap. Maybe here from very loose, but really the breakaway gap's midpoint. Even the higher the breakaway gap is a good entry, or a good stop loss rather. I would not be looking to enter on the breakaway gap. It says it's live still. Okay. Okay, good. I don't know why that happens. I thought that was fixed, but apparently not. OBS issues again. And it's also logged me out of demo. Log back in. Maybe it's my network. Oh, I'm 10 seconds delayed. I think if you double tap on your device or you just forward it towards the most recent point, then it should fix the delay. Or if you refresh. 3-second delay. I think that's the lowest it'll ever go. 3 seconds. Yeah. I thought I fixed that the other day, but that's very annoying. What's also annoying is we left the pre-market lows and we don't get set up. If you go through the price action from last week, you'll see this very same setup occurring multiple times. On live stream as well, so I believe if we go here, yeah. This was the regular trading hours gap on the 5th to 6th of November, Wednesday to Thursday's gap. It wicked into the gap, fell short of the consequent encroachment, if I put a rectangle on. Fell just short of the midpoint, and then it gave us enough weakness to keep rallying lower, to keep dropping lower. That's the exact same thing that's happening today. It's just wicked in very slightly, and obviously now we have a 300 handle opening range gap. So this is more significant of strength, or more significant indication of strength. Isn't it nice to be able to call price perfectly? Okay, want to see the 5-minute candle close beyond this high here. Want to see it close beyond that. ES is also trading higher. This is fine. Oh crap. It's the 5-minute candle that we're trading at the moment, which will close in 2 minutes and 5 seconds. I just want to see it close above this high, above the previous 5-minute candle high, and that would constitute strong bullish order flow and probably less likely of a return down to this fair value gap if it closes above that high there. Go lower. I told you. It's going to be a breakaway gap. You know how I knew that? Not only the opening range gaps reaction, but it's going through the pre-market high. When you see a fair value gap trading through a high and you're bullish anyways, and you've just reacted off something that indicates strength, like this opening range gap, we just wick it down into it 10 handles, don't even get anywhere near the upper quadrant. That's all indicative of strength. Sui knows that. Sui knows that. Sui knows that. Unfortunate that we're not on board, but as they called everything. Is anyone in longs? Out of curiosity. Not that I'm recommending the trade. What makes that 5-minute close above the high important? Like, why that 5-minute high? It's because I want to see a fair value gap form here, and if it's 3 candles that are expanding higher, although the third candle, as ICT says, doesn't play a role in the significance of the gap, it can play a role in what you want to see out of the gap. So if you want to see it react, or you want to see it become a breakaway gap, then it's better that we close above this high. And if we do, which we did, then you can just, I'm not going to say buy a premium array or a discount array, but it's more indicative that we're just going to keep running higher and higher and higher. Plus, it constitutes bullish order flow because not only is this more likely to be a breakaway gap because it's 3 expansion candles, which signifies an imbalance in buyers versus sellers. This is BISI, and then this is a candle that could form a BISI as well, but essentially it's displacing higher, displacing higher, displacing higher. The fact that it closed above this high supports the idea that if it's going to want to trade higher, it now can leave this, ignore this, because that's going to be a breakaway gap, which obviously is indicative that we're going to keep trading through without returning into the gap, meaning it's very bullish and more likely to trade through this fair value gap's high. Yeah, through the fair value gap high. Like, I'll put that 5-minute fair value gap on, and you can see it fractally. Well, I know it's not a fair value gap yet, but sorry, this one. Yeah, it is fair value gap. There you go. It's like speed thing Ronaldo Sui. Oh yeah, Sui. I'm only long on paper after that close above pre-market high. Now I'm comfortable trading this up on my funded / evals yet. Fair enough. Yeah, also, when you're constantly closing above the high and you're making high highs, not swing highs, but the following candle is a higher high relative to the previous candle. Again, not a swing point, but this candle is a higher high, and then we make another higher high closing above it, and another higher high closing above it, not swing points, just regular individual candles. That constitutes bullish order flow. I haven't even taught my private mentorship that. So closing above that 5-minute high, it's possible continuation entry signature. Generally, yes, being in premium, you wouldn't want to take it, but if we were in discount, then yeah, you could potentially take that. PM mogs anyways. Sometimes PM does mog. Sometimes. I'm not going to deny. Okay, rejecting from all the way up there means we'll probably will use this gap. Again, you want to see the 5-minute candle closing price, because if it closes all the way back up here, then obviously that's strength. But that's two big down close candles that I didn't want to see. You'll notice though there's not a single first presentation fair value gap on the 1-minute chart. We only have this breakaway gap, and beyond that it's very back and forth, where it's up, down, up, down, up, down, up, down, and it's wicky. You want to see full-bodied, thick candles that are leaving inefficiencies behind, which we're not really seeing here. So deeper retracements are possible, and it's low probability, because if it is to drop somewhere, where's it going to fall and find support? There's nothing really supporting it there beyond this bullish order block and that 5-minute gap, which currently is a breakaway gap. It doesn't need to remain one. I would like to see it remain a breakaway gap, but it doesn't need to remain one. And if this is a down close candle, this will almost certainly be filled in, which will wait. Yeah, yes, it's much nicer because we have fair value gaps forming. Okay, the 5-minute candle is a down close candle. It doesn't mean, oh, it's completely going to reverse. That can still become a bullish order block. Okay, the 5-minute gap's entered. That's fine. If we can see it find support and then give us the this candle high, close above this candle's closing price or opening price. Let me say that again. If this 5-minute or the next 5-minute candle can close above 9.45's 5-minute candle opening price, that would become a bullish order block, and that would again be favorable for longs. See, this 1-minute order block holds up. What's that blundering? Oh, what's that blue drawing where the breakaway gap formed on its CE? I don't know what you're talking about. From where it's rejected, throw a fib on that blue rectangle. I don't know what you're referring to, Nehemiah. His name's Haroon. Yeah, W name, nice name. Like the stream. Okay, we want to see this reject and leave a long wick on the 5-minute, especially because it's just tapped the close of the low of the breakaway gap. So we want to see leave a long wick where the body gets pulled up. That'll be good for strength. Plus we have the midpoint of that, I believe it's the 27th of October's new week opening gap. If we can find support around this level, we've already had a couple candles close beyond. I'll remove this stuff for a second. if we just look at the opening range gap, it's a lot easier to see here. Not the opening range gap, the new week opening gap from the 27th of October. We want to see these levels give it support. And ideally, we don't trade down into the 0.25 of that new week opening gap, because that's where a breakaway gap is. We want to see that left open, and then it trades higher. There's nothing really supporting this gap beyond it just being displacement, so it might displace through it. I wouldn't like it. But if we're going to be bullish, I want to see us trade back above this, use the 0.5 level as support, and then trade higher up into the upper quadrant, use that as support, eventually invert the fair value gap from the 4-hour chart that we were mentioning earlier. Okay. This is not my ideal first presented fair value gap, and if there's a better inefficiency that comes along, I will use that one instead. But for now, this is the only inefficiency that's formed after 23 minutes of trading. Generally, that means you're in a low probability environment. Ordinarily, I would not use that as a first presented fair value gap, but because it's the only inefficiency from that opening bell, other than the 9:30 candle, it's hard to use anything else. To be a blue zone on the chart, throw a fib on it. What if it's a blue zone? The blue zone is just a higher time frame fair value gap. This 4-hour gap. I'm not going to throw a fib on it because I'm using the new week opening gap levels. I mean, I do on, I guess, but I'm not really bothered about these. I want to see the new week opening gap levels from the 27th of October's new week opening gap be the thing that controls price here. So, having this many quadrants on, sometimes it's just going to become coincidence. What about the 1 minute fair value gap between 9:37 and 9:39? This is not a fair value gap because there's a wick in between it. Maybe on the micro it's different. Even on the micro you would not use that. Okay, that's the gap I'm using now. If you like it, then you should have thrown a fib on it. Are you talking to me? Oh, nice. I don't need to grade it. So this 5-minute candle, you want to see it create this as a bullish order block. I would expect it to make that bullish order block because we've got the long wick segment down here, which rejects, the body gets pulled up. It's traded only into the lower quadrant, slightly beyond to create the first presentation for value gap, and then it's given us the rejection that we wanted. So I would expect that to become a bullish order block, and I'm going to make that red so that we can look at it fractally on the lower time frame. If you go to ICT 2022 episode 12 and you look at fractal order block delivery, he says that any fair value gap within this fractal order block, you can buy it if you're bullish. We've already left this range, so I wouldn't do that. But, you know, generally, if we were in a discount or something, that would be applicable. Lumber top pick the reversal. Hell yeah. That's my student. Okay, you can grade the retracement like this. Put a fulcrum on that. Sorry, not a grading. Put a fulcrum on it. And that gives us distribution expectations for where we may go beyond the fulcrum. Generally, how far are you going to go beyond a high? You want to use stuff like fulcrums for distribution expectations of how far you may move beyond the measured area. Or you want to use new day and new week opening gaps. So if we have a new day opening gap above market price, above your target, and it's giving you bullish signals that it wants to keep trading higher through that target, then you can use the nearest new day opening gap, or you can use event horizon between the liquidity pool and that new day opening gap. Or you can use a fulcrum. And if you guys joining in on the leap, nah. Look, with trading competitions, it's not really about who's a good trader, it's about who can full port the most times in a row successfully without hitting a stop loss, which doesn't, in my eyes, promote good trading. It just means, because who's going to be number one or who's going to be top 100? It's just going to be people that full ported one trade or 3 trades in a row and hit a take profit most of the time. So, not that you can't join it and win, but to win one of those competitions, if you want to trade well, like, you have to throw risk management out of the window. You have to every good habit that you want to develop in trading, you have to let go of it, which, in my opinion, doesn't do anything for your longevity as a trader. It just makes you more compulsive and like leaderboard mentality. Oh, I want to become number one on the leaderboard in prop company or trading view company, trading competitions. It's not making you money, and it's not making you a better trader. So, not advice, but me personally, I would ignore all those and just focus on your trading ability, getting better at your specific model, whatever that may be. We have a volume imbalance here. I want to see that closed over. Volume imbalances are a very flexible PD array. They are the most flexible one. You're never looking for tick-to-tick precision with them, but seeing a body close over a volume imbalance is very indicative of, or very good for seeing price use that as a support level. So if we can trade back above this at some point, you could use that as support level to trade higher through this high. That's another busy. Let's see if price. Nah, okay. I'm ignoring this for now. I'm going to keep it in mind, but I'm not going to have it on the chart. But I do want to see active support. So the 5 minute go. Here's that 5 minute bullish order block high. And then the mean threshold of this, we're going to make it a white line. Mean threshold just means the middle of an order block. It's the same thing as a consequent encroachment or equilibrium, but for an order block, so don't let the big terms confuse you. I don't know why ICT decided to give it such a hard name, but yeah. I was looking on the 1 hour. Perfectly fine. Perfectly fine. ES is not as clean as I would want it right now, but it's okay. Okay, there's the 5 minute bullish order blocks mean threshold, delivering price higher. And if that's displacement, then you want to see these down close candles start to support price. And then ideally you don't leave the realms of this area. You do not want to see this traded below now. You don't want to see that traded into. It will break the SMT. See, that's why you put market structure above SMT. I just realized what you're using. You're using this. You should be ignoring that if you're bullish. Look, an SMT, if it's valid, it shouldn't even come back up this far. It shouldn't. It should give you the reaction, and then if the SMT is going to deliver a move, the speed of that move should be a lot stronger than what you're seeing here. So this basically says, I'm an SMT, I don't like that, or I don't want to deliver for you, because we're bullish. A bearish SMT will not deliver if you're bullish. Simple. Market structure comes first. If this was going to be an SMT that acted, the second we had a strong down close candle, I mean, everyone who trades SMT is selling there. They're all selling there because they're pattern traders. Trading back above 70% of that down close candle pretty much validates the SMT. An SMT should be so strong because it's aligned with market structure and true opens and general opening prices like midnight opening price, that when you get that displacement candle from the SMT, it doesn't even want to trade into the equilibrium of that candlestick. It just delivers lower immediately, which this isn't doing. We have SMT below before the move too. Well, there you go. Market structure. Tick. Valrek 1, Otaku 0. 32 people and 13 likes. I think the viewers don't like me. You know why I say that? Because this is the mean threshold of the bullish order block. It wicks down into the 5-minute candle, and we've left a long wick off that bullish order block's midpoint, mean threshold, equilibrium, whatever you want to call it, and now it's rejected. So trading back down into this low, if it does that, I'm not saying it won't go higher, but I'm saying that I wouldn't want to be in that trade. Near term, we can deliver above this high and then trade back down to the low. That's different because we've broken the dealing range at that point. But right now, to trade below this low would be very deteriorating to long setups. Man, I just hope this S&T is going to drop price to my point. Lol. It's chopping around right now, so to be honest, it's a bit bold of me to say this when we're chopping around with this strong wicks back and forth, but nevertheless, algorithmically, that shouldn't happen. It shouldn't go to that low again. With this wick now, that should be enough to trade higher if it's going to be near-term bullish. If not, then yeah, you clicked. Or maybe you return into that 5-minute high. Yeah, maybe. Maybe. This is all the stuff that goes to my head. Okay, we have a series of 3 down closes and a long trailing wick, so you want to see this closed above on the 1 minute. But again, it's very choppy right now, so don't be reliant on anything. Don't count on anything. The main way you know it's not going to deliver very nicely is because there's really not very many inefficiencies. The breakaway gap, that's one, and we don't get another one until 14 minutes later. We don't get another one until 9:53, and then we get one shortly after. But wicking, every single candle here has a wick to the upside and the downside, and it's pretty much of equal proportion, and it's elongated. You want to see fat bodies and wicks to the downside that are long. The wicks to the upside shouldn't be very long, whereas 3 in a row like that, it's a bit choppy. So you don't put your expectations really high. Okay, now that we've taken this high, this low can be returned into. Not that I want to see that, but it can. And give a tail sip because it has, from this buy program delivering above this high, it's permitted now to short-term seek discount. And if that means going below this low, it can do that. Especially if we look at where optimal trade entry is. Using the bodies of the wicks. Yeah. So that near-term bullish bias delivered when we took this high. And I don't know. Is that an hourly breaker? You have to tell me which one, because I don't know which one you're on about. That's a couple breakers here. Okay. Would you have a target price if this does break out, please? Yeah, it's this fair value gap's high. That's what I was targeting today. And then if you want to go beyond that, you want to measure this fulcrum, which is just this retracement. And you want to use 1.5 and 2 standard deviations to this level here and this level here. So 25,676, 25,705, and then the new week opening gap, 25,723.5. ICT student doesn't know which breaker. Well, there's a lot of breakers, so it could be in any one. CB coins core encroachment on the hourly. Let's check this one. The reason I'm not using the PD arrays that you guys keep mentioning on the hourly is because I've refined it by going up to high time frame, which doesn't really sound like it makes sense. But this is my preferred PD array because this is the one that had most influence over price on those days. So you remember when we were streaming on these days, we were seeing these levels of this gap being respected like crazy constantly on the lower time frames. So that's why I'm still using that 4-hour CB, even though it's been traded through, even though it's been traded through again, and we're looking for it to be traded through again. In my mind, the levels in this gap, and mainly just the gap itself, not really the levels within it, they have more significance than the hourly CB that you guys are referring to. I've been told that twice, and I think, but I'm opting to use the 4-hour CB because it's just an experience thing, really. But the delivery on this was so much cleaner than the hourly CB. Let me have some water. There we go. My selling model just formed. There's no financial advice here, bro. Okay, you know, no problem. No problemo. Okay, really weak because of how every time we want to, run higher, we keep getting rejected. Something's smacking us down. So, I think maybe the hourly up close. Just look at this for a moment. Just for a moment. We'll look at the midpoint. Okay, you can use this SMT as a potential catalyst to break out this range, but I wouldn't use it for entries. So there's an SMT from this low to this low with ES. And similarly to what I just said earlier, you want to place market structure first and then SMT, and you don't want to see a retrace beyond like 50% from this low to this displacement candle body. So you can eyeball that around here. If it's a valid SMT, this should just start running through this consolidation and then probably get into the 1.5 and 2 standard deviation levels. But there's no but. As long as this creates a bullish order block, I would assume it's going to run through these wicks because of the 1 minute SMT. Yeah. trading camp India meetup when? Never. I don't know. Well, the bias was correct, as it most of the time is. You see this 1 minute candle closes. Because if it closes far down, then the S&T is not really very strong. Unless you use the rejection block. Yeah, I wouldn't rule that out. But it's not super strong like you want to see it, but I don't rule it out. Because it's a 5 minute order block high. Effectively, that can be a 1 minute immediate rebalance. Okay, it's not a 1 minute immediate rebalance. S&T pretty much invalidated. I wouldn't want to see that deliver. Yeah. How do I know these things before they happen? How do I know? Take a cell model. Just be careful, because I wouldn't want to be trading this type of price action. Take away the full bar demo. But it's good you took on the demo. At least there's one good thing. Okay, it wicked a little bit below this candle's low, and the body got pulled up beyond the mean threshold in the 5 minute. So even though, well, not even though, you shouldn't be trading this price action anymore. You want to just chill out, relax, listen to me. But with a 5 minute count, this is the same concept as what I explained the weekly outlook. You're wicking through the PD rate and you're closing back in it, not just in it, but at a respected level. So in pretty much the upper quadrant of this bullish order block, we went all the way through that down close candle, even down into this one. But the body's closing not just at a consequent encroachment, above it. Oh, sorry, mean threshold. That's what you want to see if you're bullish. But with the way price action is right now, obviously you want to chill out a bit more. Listen to me, yeah. You might pick up a thing or two. Or three. That's spelled wrong. Wizard. I don't think you can do that. Screen froze? Oh, you gotta be kidding. No. Okay. 0.25 and 5, which quadrant is stronger? It's about what you want to see happen. So if I go up here, and I'll just show you. Say you are bearish and you trade into a bullish, or sorry, a premium array. So this is above market price. We're beginning here and we're bearish. We want to see it trade lower. Then you, ideally, the best case scenario is it leaves this PD array open and it rejects and it runs away from it. What can enable you to enter really easily though is if you trade into the lower quadrant and then trade away from it. In this case, the lower quadrant is the strongest, because if you're bearish, you don't want to see this PD array filled in. The less it fills in, the better. So it's staying in the lower quadrant. That's the most ideal scenario. If it trades into the consequent encroachment, it doesn't mean your bias is wrong, it doesn't mean it's not going to deliver, but it's not as strong as it delivering into the lower quadrant only. If it goes into the lower quadrant, or even better, it stays a little bit below it, or it just completely ignores it. This is the best case scenario, because it's refusing, because of how bearish it is, assuming your bias is bearish. It's so unwilling to trade higher because of how bearish it is that it won't even reach into a premium array. Especially now, if this is a fair value gap. A fair value gap should be a draw on price because it's an inefficiency, and price wants to be balanced, seek to balance inefficiencies and seek liquidity. If you have something below you that is, say, relatively equal lows, and you want to see these deliver, and it refuses to trade into that premium array, call this a bearish fair value gap, this is what you want to see. If it trades into the lower quadrant, that's good. You can take sell setups. If it trades into consequent encroachment, that's good. You can still take sell setups, but it's not as good as it staying in the lower quadrant. If it trades into the upper half, you have to consider the chance that your idea may be flawed, and it may want to just run through it and potentially invert it at a later time if your draws can be correct. But this may not be the array that delivers your bias. If it trades into the high and we close at the high, so we close at the high, and then we reject, this is what I taught in the silver bullet mentorship. What I didn't teach was a new quadrant methodology that ICT has included recently, but if you reject from the high of a PD array and it displaces away, not just it closed and then it's lethargic and slow. You want to see it displace away with speed. Then you can start looking for sell setups again, because this has just rebounced the PD array. It now wants to go lower. There's nothing more for it to fill here. But that is contingent on rejecting the high. If it doesn't reject the high with displacement, then these levels, they're not going to be used as resistance, they're going to be used as support, and it'll probably trade higher. Hopefully that makes sense. It's a bit of an advanced concept, but if you're going through ICT's newer 2025 mentorship, the more recent episodes, not the ones that were done at the beginning of the year, then you'll understand what I'm talking about. These are advanced concepts. What's the word? What's the word I'm looking for? Low hanging versus. What do I always say when it's higher than you should expect? My brain's gone blank. Why has my brain gone fully blank? Hopeful? Not hopeful. Yeah, I do not remember. Okay. We'll just put next. And then I'm gonna put 2.5. No, I'm not. I'm going to add the new week opening gap. Overzealous. Wait. Yeah, I think that's the word. Well, it's not overzealous, but that will do. No, ambitious. Yeah, ambitious. Ambitious distribution expectation. And then okay, just to be clear, You want to be targeting this because we're not seeing the indications of strength that you want to see. It's very slow, it's very lethargic. I would have my full take profit there and I wouldn't even think twice about it. I wouldn't care if it runs beyond it another 500 handles. I would be content with this because the price action that we're currently dealing with, it's not consistent to price action that would ordinarily deliver higher targets like this new week opening gap level. If we start to see more breaking away, like we did have a breakaway gap here and we did manipulate a low, and if this forms bullish order block, it is possible that it does distribute into the second standard deviation here. But you may be left hanging and you may not get that fill. So if it was me, I'm taking it off there. But, not an advice. And then the end of the move that I would want to see would be this. Now, at the beginning of the stream, my terminus point was this, and you can see that based on the dealing range that we've had on screen for the entire stream, from the impulse price swings low with the body of the candle, not the wick. The reason I'm using the body is because this wick, I'm not considering it part of the impulse price swing because it's sell side delivery, and I just want to incorporate the buy side delivery from where the price move began. So this is the opening price. I'm going to start there, and I'm going to end it at where I believe price is going, which is the high of the 4-hour fair value gap that we were mentioning right at the beginning of the stream. Beyond this gap, where can it distribute to? That standard deviation, and then beyond that, this standard deviation, and then beyond that, the new week opening gap. But for me, honestly, I'll take my profit right here, and I wouldn't even think twice about it. You can wait for the SIBI high to be met, but why would you want to wait that long for 20 extra handles when you've caught this? I'd be content with the move that I've already caught. However, it can probably move a little bit beyond that. This is the ugliest price action I've seen in a while. Yeah, well, there's no news this week, and there's a bank holiday tomorrow. So, 1022 order block on 0.75 of 24th to 27th October. No PPI. Well, it's government shutdown, so no PPI. There was meant to be CPI this week as well, but that's not happening because of government shutdown. You said 1022 order block on the 0.75 of the 24th to 27th October is a new week. Really? I don't think so. Because the upper quadrant's up here. I'm in a trade, real account this time, inshallah. It's a TP, gonna head off the stream. Bye, goodbye, goodbye, goodbye. Although I will not be doing anything here. I still wish you luck. Let's do a little experiment. Pre-market range, let's do this. 45 handles, call it. Okay. This is the measured move. This is one standard deviation. Because you're taking this range, you're doubling it. And let's do another one. Let's do another one. Interesting. Just a miniature thought experiment. Yeah, I feel bad for anyone who's actually trading this. Sorry, guys. Next time I'll put my 4 million contracts on and I'll give you nice price action. Promise. How do you get to read prices? What do you do in terms of reading? This is just 4 years and thousands and thousands and thousands of hours. So you're not speaking to me, you're speaking to thousands of hours of ICT. Most of what I say is ICT. Completely ICT. That's where I learned from. That's my mentor. In terms of how did I get to this stage in reading price, it's thousands of hours, but anyone can put thousands of hours in. And I know people that have, and they can't read it. They can't read price anywhere near as good as I can. It's just going through charts. That's all it is. It's just going through charts. It's literally like go to a random asset. Say we're on the hourly. About 15. No, the hourly would do. Oh. Okay, well, I'll show you now because we're here. Stuff like this. This is this thought experiment I was doing, where I would predict the closing price of. I predict the open and the close based on the daily range. It does work. What I was doing. This is me using midnight opening price and the Judas swing that creates London low in a classic buy day to predict how far we're going to expand into the daily range. It doesn't work every day, but it is something that under certain criteria that stuff does work. This is me again predicting the opening and close. So if you know where or what time window the high and low of the day is going to form, then based on where the opening price is, you can predict how far we're going to expand lower, manipulate lower, and where we're going to expand higher is going to be done with the midnight opening price and that Judas swing lower from the London open. And you can predict where we're going to close as well. All this stuff, like that's hindsight analysis, but that's not even marked up. This is just me on this layout. I forgot all about this. You know, experimenting with price. You have to do that stuff if you wanna improve. But it's time and it's effort. You go through the charts, you over annotate them, and I mean over annotate every single thing you see, annotate it, annotate it, annotate it, and collect data. And when you're collecting data, that's gonna, because you've seen it so many times in hindsight analysis, you'll learn to see it in real time. Like that pre-market range. The reason I've seen that just out of the blue randomly, I'm guessing, is because I've done studies where I measure the pre-market range on certain days of the week based on what economic calendar events there are, and then I use that range to measure how far we're going to distribute beyond the pre-market range if there's a large opening gap. So this is one of those criteria that I researched one time. And generally we do have 3 standard deviations, 2 to 3 standard deviations of the pre-market high. And then generally we get volatility falling off at that point. So we've rejected off the regular trading hours or the opening range gaps, not the upper quadrant, but we've not even reached the upper quadrant. Like we've failed to get anywhere near that. We just rejected off the opening range gap with a bullish bias. Okay, that is criteria 1 for using standard deviations on the pre-market range. Then beyond that, you look at how many standard deviations until the volatility drops off, and it's usually 2 or 3. So nearly to the tick here, we deliver that second standard deviation. This is 1, and this is 2. And then the volatility immediately drops off and it gets this retracement. I mean, that's it. That's completely unnecessary. It's just me being a fanatic. Don't mean to throw shade, but TJR doesn't read price well, not even close to you. But he is profitable, so fair play, I guess. I don't like TJR. I don't like him. And feel free to throw shade at TJR, I don't care. Nah, I don't think he's good at trading at all. Like, I looked at some of his stuff. I looked at like a couple of his videos, and some stuff he teaches is just wrong. Like, it's just wrong. Like, fair value gaps. He taught that a little bit wrong in one of his videos. And it was something very basic on when you expect a fair value gap to be traded back into. So, yeah, no. Oh yeah, I didn't even answer the question. Reading price well. I keep having to give the same answer. It's time, but mm, journaling, hindsight analysis. Like, for example, when we have a large Asian range, London's going to be subpar generally. If we have no news on that day, Asia can be low of the day, and London can still be a decent session. That doesn't come from thin air, that comes from tape reading and journaling and data collection. You forward test enough, you're going to see these things happen. Like here, large Asian range, and then London's subpar. Where's the tight Asian range? Large Asian range, London's terrible. I'm looking for that specific day. Here we go. Asia tight range, less than half of that New York PM, and then London, super amazing. That doesn't come from just backtesting the silver bullet. That comes from looking at actual price action, economic calendar stuff, and thousands of hours. TJR's rich off courses. Yeah. I don't think there's really anything wrong with having a course, but if you can't trade, then you have no right to sell a course. And if you can't call price, which I don't know if he's done or not, but if you can't call price at least, then you have no right to teach anyone. But if you can do it in front of people and call it, then teach away. Like what we're doing is, it's a live stream. There's like 3 seconds of latency. Everything I say, I can't fake it because you'll hear it 3 seconds later. So when I'm saying bullish bias, only look for long setups, and I gave the exact scenario at the start where I said, okay, we could either take these pre-market lows and use these support levels, we could either take a London low and use this support level, or we can just reject off the opening range gap and go to the pre-market highs. And what happened? The exact thing. So, that stuff can't be faked. Someone can do that in front of you, and it doesn't have to be me. Anyone that you trust to actually, call price. The reality is, you could just copy them. You could just copy them, and you'll make money. Signal service. But these live streams, they're done on a demo account. These are not. I'm never trading with real money in front of you. I do that in my private mentorship sometimes, but I'll live stream there. I'll take trades occasionally using the pre-market model and stuff. I make it very clear that in these live streams I'm on a paper trading account. There's no real money on the line ever, and that keeps me liability free. And you see my risk disclaimers at the beginning of the streams. They are bulletproof. No financial organization can come after me. Okay, still very short on inefficiencies. So this entire morning, since the very beginning, we said that there's no inefficiencies, it's low probability, and there's very few. There's very few. And when we're seeing wicks on both sides of the candles like this, that's not what you want to see if you're looking for higher prices or any reliable price run. So again, I said it all the way back here, I said it here, I said it here. You don't want to be trading this environment. Would me copying your risk disclaimer word for word be sufficient for me to use? Yeah. 100%. And my risk disclaimer is bulletproof. This is, I have two, I don't even have one, I have two. I showed them both. So this is me protected from liability, personal responsibility, all this shit. And then the other one, I can send you this if you want. This is the trading related stuff, not my liability stuff. High risk investment warning, regulatory status and financial promotions, educational content only, not financial advice, risk of loss in futures and forex, and performance disclaimers. So, and that's for the UK. So if you're in America, you can't copy that and expect it to work, because I'm adhering to FCA rules, which is the Financial Conduct Authority. But if you're looking at the CFTC, if you're in America, the Commodity Futures Trading Commission, then you have to have other disclaimers and stuff specific to basically making yourself immune from them coming after you. But I'm in the UK, so I'm not looking at the CFTC's risk stuff. I'm looking at the FCA, which is basically the UK's version of the CFTC, but it's for more stuff than just commodities and futures. Any financial conduct authority has to adhere to those rules. One second, I'll be back in 1 second. Back. Trading the setup of opening range gap 930 first for value gap, wait for price to trade, consequent encroachment of opening range gap. It's not working these days. This is why I learned to be honest and not working all the time. If you're waiting for it to deliver to consequent encroachment and it's a 300 handle gap, then that setup will not work. You have to take into account opening range gap size. So in this case, where we have an opening range gap that is over 300 handles, I think, how much was it again? Yeah, 340 handles. For it to trade at that consequent encroachment level means it's run against you 170 handles. If it finds support here, that's all well and good, but you have to take it with a grain of salt. It's not likely, if it's going to be bullish, it's not likely to run down into something 170 handles below market price and then rally from here. That's just not likely to happen. Unless it's an inefficiency, then that would be. But in a liquidity void scenario, having enough weakness to drop all the way down to a consequent encroachment, which is 170 handles away, that's not constituent to something that's going to deliver higher prices. The upper quadrant, if we had dropped into the upper quadrant today, that would be fine. Like, you couldn't see sales from here. But we didn't even go to there. We just wicked down into the opening range gap and then completely rejected, which is what you want to see, because the more of this gap it leaves open, especially when it's an extremely large gap, the more likely it is to just play touch and go. So if you're looking for opening range gap setups, you want to see this reject in the direction of your bias. So if you're bullish, you want to see it trade lower, reject higher, and then give you bullish setups. implementing the first presented fair value gap. That's fine. And yeah, you can use that setup, but it's not an everyday setup. That's not going to form every day. And sometimes, I mean, yeah, it will usually form once a week, but at least once a week. But that's not every day. Like, you wouldn't see that today. You probably won't see that. Well, you won't see that tomorrow with a bank holiday. Yeah. If you want a more reliable setup than that, because that is a good setup, but it's not something that's going to constantly form, and it's definitely not the easiest setup to trade. If you want something better, then you can use the silver bullet mentorship. Silver bullet mentorship is for free on this YouTube channel, and it's all you need to be profitable. I have students that are anyway. I have students that are profitable just from that mentorship alone. I have two now that are profitable just from that mentorship. Sui is one of them. I don't know if it's still here, but Sui can tell you he only started ICT a couple months ago, and that's after he came across my content, and then he just used the silver bullet mentorship, applied it to the London session, and then that's all he does. And he's profitable. What time is London closed? It's 10 to 12, so I don't know if I don't have it here, but with Forex, oh shit, I wasn't meant to show that. Okay, with Forex, the New York Open is from 7 o'clock to 10 o'clock, and then the London close is from 10 o'clock to 12 o'clock. Which, if you're trading Forex, is likely to be one of the extreme ends of the range. So if London Open is the low of the day, then you're likely to see the high of the day in London close if it's going to be a classic day. If not, then, you know, doesn't really matter. For me, now I have to do other analysis. Oh, nice one, Otaku. Well done. Well done. 1 to 4.1 TP. Demo trade TP is way lower. Well done, man. GG. Moneymaker Otaku. Zusi student finally hit a take profit. Damn. The 369 numbers paying off. That breakaway gap is no longer a breakaway gap. Doesn't mean you discard it. Damn, so we made a run at this fair value gap high 1, 2, 3, 4, 5, 6, 7 times, and it didn't get it. Because this fulcrum's not really valid anymore. Because we've gone from one extreme to the other extreme, so you wouldn't use this. But you can use, for dealing range distribution levels, you can use this because that was the first dealing range that formed, but really you want to use this. Anyway, it has worked buy side delivery, now wants to work sell side. Yeah. And that's gonna be, yeah, that's it for the stream. Before I lose my voice even more. Good stream, I think. Good stream. Bias was completely correct. Completely correct. Not even one thing wrong about that. As usual. Let's go to the 5 minute. Okay, we said our target would be the 4-hour SIBI's consequent encroachment, not consequent encroachment, the high. I'm just going to remove this stuff. And it was nearly to the tick. Just fell a little bit short of the upper quadrant from this new week opening gap. I think a retracement below some kind of sell side is probably the next move. So the pre-market lows are very engineered lows. That's probably going to be the next on the cards. Then this low and then inefficiencies within London can potentially provide support. If not, maybe lunch will take this, and then eventually we'll see something in the Asian fair value gaps. Maybe. Not that I'm predicting, but the only thing I'm predicting is the pre-market low gets taken. Beyond that, I have nothing. So yeah, good stream. Thank you for watching. If you've learned something or if it's been useful in your own trading, then do leave a like on the stream. Help my channel out. And that's it. Have you already done the video on the lunch hour, or is it for the roundtable? I have not done a video on the lunch hour, and I haven't done it for the roundtable yet. It won't be public if I do it, but the first thing on my cards is going to be an Asian model for the roundtable. I will reopen the roundtable soon, in like a week or two. So, yeah, I'll let you know. I will let you know. I have nothing else to say. If you have any more questions on MI, just DM me on Discord. I'll respond there. If you're not on the Discord, then put the link. There we go. Okay, I'm gonna end it now. There will be a stream tomorrow and every day for the rest of the week, including Friday. So, goodbye.